Following our brief online introduction in week 1 to the topic of emerging markets, let us now turn our attention for the rest of this week to a discussion of broad macroeconomic trends and growth drivers that make these markets generally attractive investment opportunities. This is an important starting point for our discussion of emerging markets because the broad trends that are underlying the potential and challenges of these markets in the 21st century are themes that are woven at times more prominently and at times more indirectly into all our subsequent discussions of various world regions. As a starting point, it is relevant to note the overall influence and impact that emerging and frontier markets have on the global economy going forward. Indeed, if you are eager to identify the next growth and investment opportunities, you are most likely going to be disappointed if you focus primarily on developed markets. The reason for this is rather straightforward, and some of you who may be coming from an emerging or frontier market are keenly aware of the underlying forces behind this reality. Presently accounting for over half of the global population and nearly 40% of global GDP, it ought to be readily understandable why basic awareness, informed understanding, and objective analysis of the realities and dynamics of economic growth and development, political stability or instability, and broad socioeconomic trends prevailing in emerging markets ought to be viewed as a critical necessity rather than a simple luxury. Whether you are looking at the world from a political, economic, business, security, sociological, demographic, or even an environmental perspective. Notwithstanding all the hype and excitement about the seemingly boundless potential of emerging markets, premature euphoria and hard-hitting disappointment have also been and will continue to be an integral part of a quest for success in those emerging markets. So if you are focusing on emerging markets as an investor, the obvious and basic question that you are likely going to struggle with is how to identify and select those emerging market economies that hold the highest growth potential, while simultaneously limiting your risk exposure as much as possible. Now, it should also be noted at this point that risk, uncertainty, and ambiguity emanating from political, economic, social, regulatory, and legal contexts are a fact of life. In other words, there is no single obvious formula for success in investing or doing business in emerging and frontier markets. That being said, there are, however, a set of important and relevant trends that should inform your analysis and understanding of emerging market growth potential as well as related risk factors. We will return to a discussion of risk factors in a subsequent session, but today we shall focus primarily on what can be described as growth drivers for emerging markets. It is important to keep in mind that the list of growth drivers being discussed in this session is not necessarily an exhaustive one, but at a minimum, it does capture some of the key data points and trends that should inform any balanced macro-level analysis of emerging markets. The first driver looks at emerging market growth potential through the lens of demographics. And if you think about it for a moment, you will easily recognize why this should be a fundamental point of departure for any analysis of actual or perceived growth potential. I mean, think about it from a business perspective. On the one hand, if you are eager to expand your customer base, you will of course focus on the population of a country to determine the size and potential market segment, identify the needs and wants of potential customers, and tailor your investment foray into the market accordingly. On the other hand, if you're looking for a production base, you are likely going to be attracted by the potential to tap into a young and vibrant working age population. Simply put, population growth and average age serve as key indicators of a vibrant growth potential. A growing population holds the distinct potential for an expanding customer base. At the same time, a young population, if benefiting from increasing access to good education and benefiting from high economic growth, thus generating more jobs, will provide access to a dynamic working age population, which, as it climbs up the socioeconomic ladder, will fuel domestic consumption levels. A related measure is the dependency ratio of a country's population. This ratio, as defined by Investopedia, is, quote, a measure of the number of dependents aged 0 to 14 and over the age of 65, compared with the total population aged 15 to 64. This demographic indicator gives insight into the number of people of non-working age compared with the number of those of working age, end quote. The reason why this is an important indicator for growth potential is because it shows the ratio of people that are economically inactive compared to those that are actively engaged in the workforce. The latter tend to pay more taxes. And I do say tend to pay because some emerging markets do indeed experience challenges in collecting tax revenues, owing to institutional voids or inefficiencies, as well as corruption, themes which we will return to in a later session. The larger the size of the economically inactive population, the higher the fiscal pressure on governments to provide for education, healthcare, and social safety nets, including pensions. To give you just one quick example, China's social safety net has been notoriously underfunded, which, combined with a rapidly aging population, suggested the potential for significant fiscal strain down the road. In order to get ahead of this trend, the Chinese government began to experiment in the Singapore Suzhou Industrial Park, which is located in the city of Suzhou, which is a major city in southeastern Jiangsu province, about 100 miles west of Shanghai. In this location, it began to experiment with a compulsory, comprehensive savings and pension plan for working adults, a plan that was modeled on Singapore's Central Provident Fund. And this was done as a way of addressing the inevitable fiscal pressures resulting from an aging population. Similarly, you also want to focus on the breadth and depth of the middle class. Though starting from a low base, emerging markets tend to register substantial middle class growth. While the income layers in most emerging markets continue to be dominated by people with a relative lack of spending power, the potential of those people to expand into the mass middle class, which is defined by people having disposable income for regular spending on non-essential items, is considerable. The elite class, meanwhile, tends to be but a fraction of the population, but it is also expanding significantly. Consider, for example, that China, which has lifted 800 million people out of extreme poverty since the onset of economic reform and restructuring in 1978 under the so-called open door or 改革开放 policy, which was initiated by the late Deng Xiaoping, presently considers more than half of its population as middle class. Particularly noteworthy, though, is the fact that, according to the Huron Report, a Shanghai-based organization that tracks China's wealthy population, China had 1,058 billionaires in 2020 compared to 696 in the US. As the report, which was released on March 2nd, 2021, noted, quote, China has added more new faces than the rest of the world combined and pulled away big time from the USA in the past year. Despite the trade war with the USA, China added 259 new billionaires to become the first country in the world to top 1,000 known dollar billionaires with 1,058, more than the combined total of the next three countries of the USA, India, and Germany. In the last 5 years, China has added 490 billionaires compared with 160 in the US, end quote. It is hardly an overly optimistic prediction that emerging markets will be at the center of a global emerging middle class. Now, if you find this prediction surprising, consider a 2017 study from the Brookings Institution, which predicted that an average of 160 million people would be joining the ranks of the global middle class each year between 2016 and 2022, in effect ensuring that the world would be witnessing the most rapid expansion of the global middle class in recorded history. And if that by itself is not already a stunning statistic, the study also predicted that by 2022, the global middle class will have expanded by 1 billion from its 2016 levels and would expand by a further billion by the year 2028. Moreover, the rate of growth of the global middle class between 2017 and 2020 would see the global middle class becoming a majority of the global population for the first time in history. And to top it all off, the expansion of the global middle class is also expected to account for an additional $29 trillion in spending per year by the year 2030, to reach an estimate total of $64 trillion, which accounts for roughly 1/3 of the global economy. Now, the simple reason why this growth trend in the global middle class matters for our discussion of emerging markets is because the consumers in developing economies make up almost 30% of the world's consumer spending, up from 18% a decade ago, as they become middle class. To put this further into perspective, consider the shifts in the global economy as captured in a study that was completed by PwC. This study predicted that by 2050, emerging markets are expected to dominate the ranks of the top 10 economies in the world, with China and India most notably reclaiming the top 2 spots, which incidentally they held up until the early 1800s. According to the same study, Vietnam, the Philippines, and Nigeria are among the emerging and frontier markets to watch most closely. Writing in 2007, Antoine van Agmael talked about how the emergence of world-class companies from developing economies would usher in what he called an emerging markets century. The following year, Kishore Mahbubani, the former founding dean of the Lee Kuan Yew School of Public Policy at the National University of Singapore, wrote a book titled The New Asian Hemisphere, in which he outlined the seemingly irresistible shift of global power to the East. A decade later, those predictions seemed clearly on track to materializing, with PwC predicting that between 2016 and 2050, China and India would gradually but irreversibly secure the dominant contributions to global GDP, effectively sidelining both the United States and the European Union. At the same time, global economic power would invariably shift from the Group of Seven, or G7, that is, the intergovernmental political grouping consisting of the world's leading industrial nations, Canada, France, Germany, Italy, Japan, the United Kingdom, and the United States, to the emerging seven, or E7, comprised of Brazil, China, Indonesia, Mexico, Russia, and Turkey. If you're curious to learn more about the rising middle class in emerging market economies, feel free to check out this documentary titled "Where Did a Million Chinese Millionaires Come From?" I will post a link to this documentary on this week's Canvas page. Now, apart from looking at the potential for a rising middle class in emerging market economies, it is also insightful to focus on both current and projected unemployment trends. It goes without saying, of course, that rising unemployment is hardly an indication of vibrant economic growth and thus long-term development and investment potential. In fact, unemployment figures, if analyzed in their correct socio-political and socio-economic contexts, can offer valuable insights into emerging market risk factors, particularly prospects of political unrest and instability. Indeed, no economy, whether developed or developing, is inherently immune to the socio-political and socio-economic pressures of high and/or rising unemployment levels. And while we shall return to this issue in our subsequent regional discussions, suffice it to say at this point that a combination of a youthful population and low employment prospects can dramatically increase the possibility of political unrest and broader societal instability. For example, the conditions that fueled the fires of the so-called Arab Spring that spilled over much of the Middle East and Northern Africa in the early 2010s offers a unique perspective on the type of market volatility and risk that prevail in emerging and frontier markets today. After this somewhat extensive discussion of demographics, let us now briefly reflect on the second growth driver, that is, the economic conditions prevailing in any given emerging market economy at a particular point in time. The usual suspects in terms of general macro-level economic data that you may want to focus on at the outset are overall year-on-year GDP growth rates as well as GDP per capita growth trends. Excessive and recurring volatility in these measures should certainly trigger a more focused and comprehensive analysis of the underlying domestic and, to some extent, external contexts. The level of investment as a percentage of GDP, especially investment in R&D, research and development, and technology, can be seen as a valuable gauge to ascertain a government's development priorities, as well as overall commitment to improving macro-level competitiveness, economic efficiency, and productivity. The debt-to-GDP ratio, which effectively compares a country's level of public debt to its GDP, is a valuable indicator of a country's inherent ability to service its outstanding debt level. As a general rule of thumb, debt-to-GDP ratios of 60% or higher should definitely compel greater scrutiny to assess the possibility of sovereign default. In fact, a study published by the World Bank on June 22, 2013, titled "Finding the Tipping Point When Sovereign Debt Turns Bad," which was based on the yearly data set of 101 developing and developed economies spanning the years 1980 to 2008, concluded that economies exceeding 77% of debt-to-GDP ratios for prolonged periods of time were much more likely to witness significant slowdowns in economic growth. Specifically, the study noted that, quote, if debt is above this threshold, each additional percentage point of debt costs 0.017 percentage points of annual real growth. The effect is even more pronounced in the emerging markets, where the threshold is 64% debt to GDP ratio. In these countries, the loss in annual real growth with each additional percentage point in public debt amounts to 0.02 percentage points, end quote. So as you can see, debt to GDP levels are a valuable, indeed critical gauge of macro-level economic health and growth sustainability. Absent proper contextualization, however, please remember that debt to GDP ratios provide a less than comprehensive assessment of emerging market risk factors. And finally, the level of a country's foreign exchange reserves offers general insights into a country's ability to defend its national currency against dramatic devaluation or the risk of outright insolvency. Next, a comprehensive analysis of the growth prospects of emerging markets should also take into account the nature, health, and process of a country's financial management. For example, is the level of access to credit broad enough to foster and sustain entrepreneurial ventures, while simultaneously based on solid credit risk management principles, so as to avoid unnecessarily high non-performing loan or NPL ratios? In other words, is there a due diligence process to assess a borrower's creditworthiness, whether those borrowers be individuals or corporate entities? Additionally, you want to gauge the level of foreign exchange volatility. The higher and more persistent those volatility levels, the more pronounced and consequential the risk of investing in an emerging market. A contemporary and highly illustrative example of foreign exchange volatility is the 40% drop in the value of the Turkish lira against the US dollar in 2021. At the very heart of the lira's troubles was the Turkish Central Bank's November 18 announcement to cut interest rates by a full percentage point. Now, this was already the third cut since September 2021, and the bank also signaled at the time that it would engage in another rate cut in December. Now, if any of you have an economics background, you might argue that by itself, a rate cut is not necessarily always bad, given the right contexts. Lowering the interest rate usually leads to the currency becoming less expensive to borrow and consequently less valuable relative to other currencies. And this is usually not a bad move when the government intends to jumpstart economic growth and when inflation levels are low. After all, a rate cut under these conditions tends to prompt consumers and businesses to borrow more money, while also increasing the cost competitiveness of a country's exports, i.e., making them less expensive. The problem for Turkey, though, is that the COVID-19 pandemic has already resulted in excessive supply chain bottlenecks that have led to serious price pressures, which in turn have seen inflation levels soar. Cutting interest rates in times of high inflation is bound to further exacerbate inflation levels. Add to that the realization that the Turkish economy depends to a large extent on external financing, meaning that servicing foreign currency denominated debt has become even more expensive in a repeated rate cut environment. And now you can understand why the Turkish lira went into a free fall. Now, this example also reinforces the point I made earlier when talking about debt to GDP levels, which is that all economic indicators need to be assessed in a broader domestic and/or external context in order to yield tangible and objective analytical value. A final point to consider in the context of financial management as a growth driver is the issue of sovereign rating. A sovereign credit rating offers insights into a country's overall credit worthiness. Put differently, it indicates the level of risk incurred when investing in a country. Now, various rating agencies such as Moody's Services, Fitch Ratings, and Standard & Poor's provide such ratings, which among other things are generated based on a country's level of political stability, economic growth, and development trends, as well as overall national creditworthiness. The nature and volume of trade can be another indicator of growth potential for emerging and frontier markets. When considering trade data, it might be useful to look at a country's current share of world exports. Of course, it is to be noted here that this number would be rather small, if not insignificant altogether, for rather small emerging markets. In such circumstances, it might be more useful to assess the overall growth potential and expansion of that country's share of world exports over time. Now, doing so would then also require a careful analysis of government policies related to export-oriented manufacturing activities, for example. Relatedly, a country's trade balance will also yield interesting insights. The trade balance refers to the difference between a country's import value and export value over a specified period of time. If the trade balance is positive, a country is said to enjoy a trade surplus. In other words, the value of the exported goods exceeds that of the imported goods. Conversely, a trade deficit means that the value of goods imported exceeds that of the exported goods. Now, on the whole, the trade balance is also incorporated in the determination of a country's current account, which in turn is an important gauge of a country's economic health, considering that the current account reflects the sum of the balance of trade, net income from abroad, and net current transfers. Now, when it comes to trade, you also want to carefully consider whether a country may be too dependent on exports or rely on only a few primary trade partners, because such a reality could potentially spell significant economic vulnerability. Consider, for example, a country whose economic activity revolves primarily around natural resource exports. If the global economy contracts and the demand for natural resources goes down, this country will be squeezed economically. That is what economists would call the resource curse, and we shall touch on this phenomenon again in some of our regional discussions. In a similar vein, a country relying on a few primary export markets can find itself in serious economic hardship if the trade partner or partners decide, for whatever reason, to source from other countries, thus effectively cutting off a vital economic lifeline to the export-dependent country. The resulting economic hardship would be made all the worse if the export-oriented economy would be unable to redirect exports to other countries. One of the scenarios leading to such an outcome could involve the imposition of trade sanctions or embargoes by the international community. Now, for example, North Korea, which is arguably the frontier of frontier markets, is heavily dependent on trade, both exports and imports, with China. The range of trade sanctions and restrictions imposed on the regime in Pyongyang make the maintenance of an export channel to China a critical necessity. And if China were to decide to no longer accept imports from North Korea, the regime in Pyongyang would find it extremely difficult, if not impossible, to credibly compensate for declining levels of trade with China. Finally, it is also important to develop a comprehensive understanding of the trade policies that are being implemented by governments in emerging and frontier markets. In other words, what is the degree of openness to trade? What, if any, barriers to trade are put in place by the government and why? Are such trade barriers applicable to economic activity at large, or are they limited to specific industrial sectors as a way to shield domestic industries from early foreign competition? And related to that, has the government been consistent in the application of its trade policies? Now, we already know that emerging and frontier markets tend to be inherently risky and uncertain environments to work in. This is particularly relevant with regards to political stability and governance, which is our fifth growth driver. Political risk is an undeniable prospect in many emerging and frontier markets. As such, you want to develop a keen awareness of the prevailing political dynamics and societal realities. Who are the main players in the political arena? What are their ambitions? How attuned and responsive are they to the needs and concerns of the citizenry? These are some of the basic questions that you may want to reflect on. The prospect of political unrest and instability invariably heightens the risk of doing business in emerging and frontier markets, and it is thus imperative not only to appreciate those risk factors, but more importantly, to develop relevant and appropriate contingency plans if the decision is made to commit to those emerging markets regardless of the known risk factors. Apart from macro-level political risk, understanding the breadth and depth of corruption is especially critical, both from the perspective of legal liability as well as operational efficiency. On the legal side, for example, it is not enough to be aware of and be able to navigate the comparatively underdeveloped and inefficient legal systems of emerging and frontier markets. Rather, it is crucial that emerging and frontier market ventures align with anti-corruption practices embraced in your home country. It may well be the case that corrupt practices are simply a normal part of doing business in an emerging or frontier market. But if such practices run counter to home country practices, a business is bound to incur substantial legal liability. American multinational companies, for example, are generally expected to adhere to the Foreign Corrupt Practices Act, lest they be legally liable for practices such as paying bribes to secure contracts, even if such activities are deemed part of the normal cost of doing business. The nature, transparency, and efficiency of regulatory processes is equally crucial. It is generally understood, if not accepted, that regulatory frameworks in emerging and frontier markets tend to be comparatively underdeveloped and inefficient, or, in extreme cases, altogether non-existent. Either way, the result is an institutional void, to borrow the term coined by Harvard Business School's Tarun Khanna. And while this reality adds to the ambiguity, uncertainty, and overall risk level, it also opens the door for potentially path-breaking entrepreneurial activity, as we shall see in subsequent discussions. Before entertaining the idea of a business venture in any emerging or frontier market, you would want to take a careful look at the overall business conditions in the target economy. One critical indicator to help you assess business conditions would be to look at the country's Ease of Doing Business Index ranking. The index ranking is based on a subset of 10 sub-indices, including starting a business, dealing with construction permits, getting electricity, registering property, getting credit, protecting investors, paying taxes, trading across borders, enforcing contracts, and resolving insolvency. A second factor to consider is the role played by state-owned enterprises, or SOEs. Indeed, SOEs may well dominate the economic landscape in a particular emerging or frontier market, and you want to get a solid understanding of the nature of their operations and their influence in and connection to the political superstructure, the better to gain a clearer understanding of whether and or how to compete against them or cooperate with them in the marketplace. Arguably, one of the most promising growth drivers in any emerging or frontier market is the state of technology and infrastructure development, as well as support for an active nurturing of an innovation ecosystem. Look for signs of innovative activities and the overall evolution of innovation, the extent or lack thereof of internet penetration and connectivity, the state of the digital divide, the number of patent applications that have been filed, the current state and plans for future development of transportation and power infrastructure. After all, the more committed the government is to fostering innovation, increasing connectivity by bridging the digital divide, and investing in state-of-the-art transportation infrastructure and reliable power grids, the more attractive of an investment opportunity the country presents to outsiders. To illustrate the importance of technology, innovation, and infrastructure development, consider these simple facts. While emerging markets tend to have a mobile phone penetration rate of approximately 50%, formal banking only reaches about 37% of the emerging market population. To put it more concretely, in the West African country of Ghana, the Export-Import Bank of Ghana featured one bank branch and one ATM for every 10,000 people, compared to 5,100 mobile phones per 10,000 people. What this example shows is that there is a distinctive commercial opportunity for the development of mobile banking, and in this case, not just in Ghana, but in emerging and frontier markets more broadly. The global management consulting firm McKinsey & Company commented on this opportunity in a February 2010 article titled "Capturing the Promise of Mobile Banking in Emerging Markets." In it, it noted, quote, "The very small deposits and loans held by poorer customers make them unprofitable for banks that use traditional delivery models. But mobile devices reduce the cost to serve customers by 50 to 70%, making it possible to offer financial services to a vast population once considered unprofitable," end quote. Now, we shall return to this theme in our regional discussions of Northeast and Southeast Asia as well as Sub-Saharan Africa, at which time I will provide more concrete details as well as audiovisual illustrations, so stay tuned. Now, as you recall, we began this discussion of growth drivers in emerging and frontier markets by focusing on demographics. By themselves, however, demographics are most certainly not destiny. Rather, in order to capitalize on the full potential of demographics, a concrete, unambiguous, and deliberate emphasis on human development is needed. And this includes focused attention and clear prioritization of provision and access to education and healthcare. Additionally, governments should prioritize investments in basic job skills and provide a conducive and supportive environment for regular upskilling. Creating an ecosystem centered around tangible human development, combined with the requisite education levels that will attract value-adding manufacturing activities, is bound to help emerging and frontier economies embark on a sustained economic growth and development path. As the history of economic development has shown, the quest for economic growth and industrialization has all too often come at the expense of environmental considerations. It is thus natural to assume that emerging and frontier economies, given their latecomer status to industrialization, are similarly going to dismiss environmental concerns in the short to medium term. However, in the contemporary context, emerging and frontier economies would do well to embrace the notion of sustainable growth and industrialization. And indeed, initial signs are somewhat encouraging in this respect. As noted in the Cornell Chronicle article titled ESG Pressure Takes Center Stage at the 2021 Emerging Markets Institute Conference, which was published on December 8, 2021, quote, "Emerging markets are taking big strides towards doubling down on their ESG or environmental, social, and governance efforts. Most of the E20+, which stands for 20 emerging economies plus China, which is treated as a special case, most of the E20+ countries have made notable progress. For example, the number of Principles for Responsible Investment, or PRI, signatories from emerging economies increased by 50% in 2020 alone," end quote. But much more still needs to be done. As the article continues, quote, "One of the biggest obstacles today is poor availability and quality of ESG data, which limits investment firms' ability to identify investment opportunities, as well as their willingness to take a risk by pouring money into emerging markets," end quote. The point here, however, is both clear and unmistakable. Emerging and frontier markets that embrace sustainable growth and development practices and take pains to create a conducive ecosystem that will allow them to take advantage of technological leapfrogging are bound to chart a promising path for the future. And finally, the last growth driver that I would like to highlight is the development of efficient capital and financial markets. In order to embark on a sustainable growth and development trajectory, the governments of emerging and frontier markets will do well to expand the breadth and depth of their financial infrastructure, while simultaneously aiming to achieve, or at least trying to make tangible progress towards increasing, efficiency and integrity. Related to that, governments will also do well to create a more transparent and inviting environment for inward foreign direct investment flows, so as to reinforce their growth and development targets. In our Week 2 theme, I will offer some additional thoughts on this last growth driver. For now, I hope we have achieved our initial objective, which was to provide you with a broad overview of macroeconomic trends and growth drivers in emerging markets. Thank you for listening, and stay tuned for our next discussion on finance, development, and growth in emerging markets in Week 2 of the course.